All right. And let me get it kicked off. So we're really excited to have good friend of the buddy community and actuary Robert Eaton joining us today, where we're going to talk about some actuarial topics in the worksite long-term care market, where Robert is one of the leading subject matter experts. So with that, Robert, let me turn it over to you, and I'll kind of Q&A as we go through this. And if you have any questions, as usual, just type them into the chat, and I'll read them out loud for Robert.
Yeah, awesome. Thanks, Mark. Thanks to Buddy for setting this up, and really glad to chat with the group here. I've attended, I think, a couple of these in the past, and Mark, I've known you for quite a while. My background, for those who don't know, I am an actuary, and I work for one of the consulting companies. I work for Milliman, and most of our clients are insurance companies. So a lot of my work is helping insurance companies with long-term care pricing and setting up reserves and similar things, helping kind of develop products, put them together. And so I was talking with Mark and with I think Jason and saying, hey, is there something here that might be useful for this study group? So hopefully the answer is yes. And I feel free to shoot questions on over. And just again, very glad to be in front of you all. So
I think we can all say we're all self-described LTC nerds, so go as deep as you'd like to go. We just eat it up and love to have more ammunition to present to clients, right? The more we
Great.
understand about the products, the more confidence we can have in the pricing, the more conviction, right, there is in terms of what this is going to look like in 10, 20, 30 years.
I love it. I love it. Yeah, I forget at the CLTC conference, I picked up a couple of those LTC nerd stickers, and I've been putting them on all of my children. I stick them on my children's backpacks and stuff like that. So I have a 9 and an 11-year-old. So I'm in the thick of it, like you, Mark. Um, so I do have a screen to share. Let me see if this works. Let me try to share real quick. Let's go with this. Let's go with this. All right. Y'all can see that. I'm just going to leave it in this kind of, I guess I can try to hit present. Do you see just the full screen?
Yep.
Oh, hey, it worked. You never know. Um, so thanks again for having me. I've told you a little bit about myself. I do want to kind of get into a little bit how we think about individual hybrid life and long-term care products, and then also kind of dig into the group and the worksite life and long-term care products. So my background, a long time ago, I worked at John Hancock. I was the group pricing actuary for their for their standalone product, for their group standalone product, Care Choice and Corporate Choice, if you all kind of remember the lingo from those days. And I know John Hancock is now making a splash with the new hybrid product that they're putting out. I'll talk a little bit about some actuarial considerations, and then also some of the trends I think that are going to matter to these life and long-term care products. This is what ChatGPT gives me when I say, show me a picture of a slightly elderly person who's enjoying the fact that they planned for their future retirement and golden years. And so that looks very pleasant. So thank you to the AI for this picture. Um,
Love it.
yeah. Uh, when I start talking about hybrid life and long-term care products, and I'm thinking as an actuary, what are the sort of risks that I see in front of us? And I think first about who's the customer for these products. On the individual side, if I'm thinking about somebody who's going out and they end up purchasing a life and long-term care hybrid product, let's put annuities to the side for a little bit. Let's just talk first about life products. Here we think like the MoneyGuard type product, or Securian, or Nationwide, or One America, one of these. These are people who are planning for their future retirements. That maybe they perceive that they're going to have a long-term care need, but I mainly view these people less as like primarily insuring their long-term care risk, and more as part of a general planning conversation. And so you all are kind of the experts here. You all will tell me if I'm getting that wrong. But when I speak with brokers and agents who sell this sort of thing, they're often financial planners, and this is the conversation that they're having with folks. the underwriting that, we see companies ask for comprehensive kind of underwriting with physician statements, prescription drug histories, medical records are kind of being pulled, and an assessment on the mortality component for the applicant. And we see a lot of different chassis available, in the market, UL and indexed UL and whole life, and there's a variable universal life policy. It's a very different perspective in the group and the work site, where these are usually employees and they're not kind of on the brink of retirement. Perhaps they're often, if I look at some of my clients who are selling worksite hybrid life and long-term care policies, their average issue age is something in the 40 to 50 range. It's maybe 40 or 45 years old. These policies are usually not very large. Their face amounts are, in the tens of thousands, maybe $100,000. And the underwriting is usually a fairly, liberal compared with like an individual product. So the group for employees, under a certain limit, they have guaranteed issue, or maybe there's limited underwriting over that. Maybe their spouse has simplified issue, or something like that. And some groups are not even written, right? I mean, you all probably have this experience if you sell any kind of work site sold LTC or hybrid LTC. Some groups don't really even make it to the floor. There's kind of like a conditional guaranteed underwriting that the group itself has to sort of pass underwriting. Not all groups, I guess, are offered. And the chassis that we see, the chassis that we see today in this space, whole life, universal life, and most prominently now, this kind of permanent term product. Sometimes I've heard it called perm term, which sounds like a hairstyle. But it's an interesting product. I'll talk a little bit more about that in just a second. These are When I think about, an individual and a group kind of hybrid life and long-term care product, this is kind of what comes to mind for me immediately. But maybe I'd ask the audience, are there other things that you would kind of call out? And the next slide, I'm going to talk about kind of the long-term care riders, but other kind of big important distinctions here in these, maybe in the sales process or otherwise.
Well, I definitely think I'll just chime in, but feel free to unmute or type in the chat any comments you have. I think they're designed similar to the individual products. I think one of the unique features that we see on the group side now is this restoration of the death benefit,
Yeah.
which of course confuses people that have been in long-term care for a long time, because they're like, is that restoration of benefit? Nope, not quite the same concept. But what are your thoughts around why that's kind of emerging as a thing on the group side, where you're getting both the life and the long-term care benefits?
Yeah, I have a like a just so story for that one. So we'll see how this lands with you all. Um, on the individual side, acceleration of benefits for long-term care, then extension. There's often an inflation protection feature added. Inflation protection features might not matter as much if you have a variable universal life or something like that. Um, but they're often there, and this is all in addition to kind of the account value growth. But on the work side, the one defining kind of feature that you called out, Mark, is the restoration of death benefits. And um, I think the reason it's there is that some early writers of worksite hybrid life and long-term care products wanted to offer, not only acceleration of benefits for long-term care, like say on their UL product, but they wanted to offer something else. They wanted to offer more long-term care. And I think they wanted to do so without kind of calling attention to, like, to the regulator, for instance, of just how much long-term care that would mean. And so they kind of they kind of sidled in what they called the restoration of the death benefits in the event of long-term care. And so what they essentially sold was an acceleration with a restoration of benefits at the same time. And I think it kind of passed regulatory muster because it was sort of state regulators almost viewed it like an acceleration policy
Right,
with
they're
the
not going above 100% from like a technical perspective.
Yeah, like on paper, perhaps they're not really going above 100%. Um, so I think that's where it came from. If I'm perfectly honest with you, I know some of the people who have told me some of that story. So I think it was there in order to beef up an acceleration of benefits without kind of causing state departments of insurance to say, "Hey, this kind of looks and smells like a lot of long-term care. Let's regulate it more formally."
And
Is that
then
cynical? I don't know if everybody thinks that's cynical or not, but I think that that's probably true.
I think it's practical, and that's what you do as a carrier is work within the existing rules of the road and figure out, how to not um, kind of break the system, if you will, or have to compete against, the system. But take that further, like the extension of benefits, and we've heard recently certain states, cracking down on whether extension of benefits, is something that's allowable, right, by their regulations. But where did that come from, and what's your take on where that extension of benefit world is going? Because it seems like every one of our top carriers has an extension of benefit rider now.
Right, right. I mean, extension of benefits makes like the most sense to me. It's almost like a natural extension of the idea of a hybrid extension, or the idea of a hybrid product where you have a life insurance amount and then you want to use part of your life insurance amounts for long-term care. That's the hybrid nature, kind of like a single, at least in one sense, a single pool of money that you can pull from both. And the extension of benefits, in concept says if I use that single pool of money for a death benefit or for long-term care, if I use it all up for long-term care, then, is there some way I can give my policyholder even more? That's the extension of the pool of money for long-term care. So that's been around on the individual side for quite some time. Um, and here we see it on the group and the worksite side. It's more and more popular as companies are realizing how valuable, customers find that to be. Um, so they started off light with the acceleration and this restoration, and they've moved into extension, probably in part because, the Washington Cares Act, and they'd like to be able to have something they can provide that satisfies that mandate. But also, if you have enough carriers doing that, and Mark, you and I have talked a couple times about this, having those richer long-term care benefits eventually becomes a competitive advantage for you as a carrier.
For sure.
Um,
And then, one of the knocks on the group and worksite marketplace is not having the inflation protection with many of the products, but we're starting to see that pop its head up too a little bit here. Any kind of comment you put limited inflation protection, what does that kind of mean from what you've seen around the worksite marketplace?
Yeah, I think in the individual market, you're going to find that all of those major hybrid carriers have an inflation protection option, almost like by the book. They're going to have that offered in some way. The group in the work site, because they've sort of been like sending people in, two by two into the dragon's den. They've been kind of creeping up their long-term care benefits little by little, the acceleration, then the restoration, and now the extension. They're pretty gun shy about long-term care. Just to give you their perspective, if I'm a chief risk officer, a CFO at a a big workplace benefits insurance company, they have fear of long-term care, frankly, and it's people, like, part of my job is making them not fear it so much, honestly. And so they don't want to offer inflation protection. They're worried that offering inflation protection will attract the sort of really high risk people that they saw, take the long-term care standalone market and turn it into a wasteland of rate increases. And they don't want that. They don't want that to happen on their watch. So, you know, they're out of the gate, they would prefer not to have to offer inflation protection. But, the NAIC requires, if you're going to offer long-term care, you have to offer inflation protection. That's in the laws. And so many states have regulated this and maybe have not recognized that there's a big long-term care benefit being offered through this extension of benefits in the worksite. But more and more, the NAIC, the commissioners, and their regulators are kind of calling that long-term care and then asking the company to show where the inflation protection is being offered. And so little by little, you've seen, I think in all state benefits, you've probably seen like an inflation protection that inflates the monthly benefit, but doesn't inflate the total pool of benefits, as an example. So is that like really inflation? It's something, but it's not inflating the total amount of money you can
It
get from.
allows you to get your money out sooner
That's right.
if you need
That's
it. Now, and also obviously we've talked about this on this in this group that in California and Utah it's designed differently where it does inflate the pool
yeah.
of benefits. So it seems like state by state it works differently.
It's state by state, and I think more states are going to kind of glom onto this notion, Mark. I think more states are going to sort of find that, oh, wait, this is long-term care, and these companies should be offering inflation protection. Um,
Mhm.
but just because it's sort of on offer, doesn't mean it ultimately makes it down to being offered to the employee, right? The benefits advisor may decide, that they don't need or want to offer the 5% inflation or something like that, such that the certificate holder, the employee, only gets, you know, only gets an offering of, acceleration and restoration, and that's it.
Yeah, what we've seen some carriers do strategically is they're required to file with 5%, but then they just price it so that it's so expensive that nobody's going to choose to take it because you don't have to, have people take an inflation offer, just it has to be an option for them.
That's right. That's right. Um, One other thing kind of specific to the work site I wanted to mention, and I wonder how often this kind of creeps up in your work, is, traditionally products have been offered on like a whole life or a UL chassis, and you all probably understand these insurance products deeper than I do. But, permanent term products in the work site uh, have really kind of made a showing in the last few years. There's no cash value like there is a whole life product. It's only like a death benefit. It's like a 20-year term, but instead of a 20-year term, it's all the way to year 100 or maybe 120. Um, we've seen that companies have actually like decreased the death benefit at a certain age, maybe the 25th duration or maybe age 70 or something like that. Or other companies have actually not guaranteed that the death benefit will be available, the original death benefit will be available the whole time. It's a non-guaranteed contract. Um, so that we see that on the worksite market. It's not available on the individual market for this kind of obscure, like actuarial reason that it doesn't pass the standard non-forfeiture law for individual policies. So it's like a weird gotcha that they can't offer these in the individual market, but they can offer them in the group market. Uh,
Yeah, I would say from our perspective, and other people on the call can probably give us their feedback too. This has been very well received, this concept.
okay.
Because we're working with, I'll say, clients that are buying less coverage, more of the mass market. And the concept of buying a term policy, I think for a lot of them, makes them feel like they're getting something that's less expensive, that they're more familiar with, because there's obviously higher penetration there. And the idea to get your long-term care on a term policy is very novel. And also it feels a little contradictory, right? Because is my long-term care going to expire? Not if the term's duration is 121, like you said. So I think that plays very well. It's almost a very innovative concept that most people we present it to really like. And it feels like you're going to get something simpler. Now, as you can tell from some of the other bullets on that list, it may not be as simple as it appears in terms of how it's constructed, but it's very, I'll say, palatable from a consumer perspective to feel more comfortable about what they're getting.
I'm glad to hear that feedback. And that's the intention. The insurers who are kind of creating these policies, they've heard that like sell a life insurance policy at almost as cheap as you can get it, so to speak, such that the coverage costs as little as you can just to cover the death benefit and then add on long-term care benefits onto that. And that's what we have. One of these policies with an acceleration, a restoration, and an extension, for like a $50,000 face amount that could get you $50,000 of life insurance coverage, and then maybe 50, 100, maybe 150 of long-term care insurance. it might just cost 800, 900, $1,000 for a 40 or 45-year-old, the meaty spot in the worksite sale.
Per
So
year. Yeah.
per year. Yeah, per year. But that premium compared to what they would need to buy a standalone long-term care policy, for instance, with full underwriting, it's a good deal in many respects.
Yeah, it is reaching another target market where you really need a streamlined experience and a higher volume to make it make sense for everybody in the ecosystem, including the carrier, which has operating costs. But if you're getting a lot more people to apply at the same time, then you're getting enough premium to kind of spread that cost out. And I think for brokers too, people on this call too, when you have large groups and you're offering even premiums that are $1,000 a year, um, it's a very good market to be in because you're getting people a starter plan at younger ages that you can then add more comprehensive coverage to later. But I think that's been kind of missing in the market where it's been very well accepted in the group life, group DI market. You have that base plan. So this has created that base plan role in the LTC market that didn't really exist anymore.
Yeah,
Now the death benefit reduction I think is interesting, and a couple of carriers use that. I think it's a story you have to tell because it's not intuitive for the consumer. So I think it's complex, a little bit more complex. But the story makes sense in that we want to reduce your life insurance coverage when you don't need it as much anymore. So almost like going back to, well, it's a permanent term, but we're gonna make it more like a 30-year term on the life insurance component and more permanent on the long-term care component, which
yeah,
of course allows you to kind of get optimize how you're spending your dollar. You're not overpaying for something you don't want or need. And even on the individual hybrid side, right? Sometimes the goal is to minimize the life insurance benefits and the cost to maximize the
sure.
long-term care benefits. So it does make sense, but it does need more of an advisor and or a benefit counselor and a webinar, and you really have to educate on that piece because without someone telling that story, they might be confused by it.
Yeah, yeah. If I think to our mutual friend John O'Leary, who many years ago was a big proponent of, a plan called Life Stages, which had kind of life insurance coverage until retirement and long-term care kind of on the back end, as you will, if you will. This is kind of accomplishing that in some small way. It is kind of staging that benefit, at least relatively.
Yeah. And especially when we are encouraging people buy something that you can afford that you plan to keep for your life, it plays really well in that story. Unlike other worksite benefits where you're really buying them and deciding every year if you want to keep it or maybe not taking it with you into retirement, these being fully portable and at the same terms of when you were an employee to be able to take it with you into retirement, it's a huge selling point. It's also somewhat counterintuitive because they don't see it on all their group benefits, but really, really attractive and well received, when presented to all the people we talk to.
Yeah. I've been sharing some of these statistics. I'm an actuary. I have to have statistics. We survey the worksite life insurance companies every year, and we collect information about sort of the underwriting that they do and the products that they sell. And recently, we've really been drilling down on the sort of long-term care type products that they sell. So this is actually available in a public document, which I'll share with you as soon as I can get it up on the website, either today or tomorrow. So I'll send this link to Mark, and you can decide to share it or find me on LinkedIn. I'm on LinkedIn everywhere. But when we look at total worksite life insurance sales, this is products with and without a long-term care rider. We see like overall about a 7 to 8% growth rate over these 4 or 5 years. There's a dip in 2020. There's a pandemic. There's probably less employee benefits being sold in general just because of uncertainty. But then, of course, in 2021, we have a big jump, and this is largely driven by Washington Cares to 734 million in worksite life sales, and it tapered off a little bit after that, but we're still back up to 730 million, and I think tracking north of that in 2024. So we continue to see progress here. A meaningful part of all of these worksite life sales are sales with, policies with the rider, a long-term care type rider. And we ask that question too. Are there acceleration only or acceleration with restoration, with extension, or with all three, or maybe with no chronic illness riders? And so we see these kind of breakdowns. So for instance, for universal life, about a third of policies, 35.4%, have acceleration only. About a third of the policies have no rider sold, but the rest of them have some kind of acceleration with restoration and extension, or even more. Um, and it looks kind of similar on permanent term. 10 or 20-year term, there's some acceleration only policies. I don't know about the acceleration with extension, by the way. I'm not sure about those. Sometimes you got to worry about the responses to the survey. But we try to get all these straight. And then on whole life, there's some acceleration. Whole life's already a little more expensive, right, than UL or permanent term.
So
Um,
I'm reading this correct, though. More policies are sold with chronic illness or LTC riders than without in the group
that's
life.
right. Yeah, yeah, that's exactly right.
So 52% versus 48%.
Yep, you're reading that right.
I also think that that big spike on the last slide in 2021 is also interesting to note because that's just one state. This is
Right.
this is like all of the sales across every state. Washington Cares drove 260 million maybe of growth, or a large chunk of that growth, just because of the payroll tax. But that's sustained, and I think when you project this forward, we had maybe two or three carriers back in 2021 that had group hybrids. How many would you estimate carriers have long-term care today?
I think like 8 to 10. Yeah, I would have said three or four back in
Mhm.
2021. I would say eight to
That's right.
10 now. I mean, it's a decent amount.
Yeah, and I think when you look at growth in a market, right, you have three times more suppliers, you're going to see just that driving growth just because supply is going to generate its own demand in a lot of respects.
That's right. Um, here's a here's another kind of quick slide. If you look at the sales, of all worksite life, it looks like uh, just over a third are whole life and just over a third are UL, with a little bit of this perm term, at 1 out of every 6 or so. But if you look at those with the riders, most of the policies are kind of selling acceleration only riders, but more and more we have the restoration and the extension, and then the combined restoration and extension kind of in there. So we're monitoring this, pretty closely year over year, and kind of look forward to seeing more and more LTC as part of these sales. But we are kind of keeping track of all of these things.
Yeah, and I think it also is a function of like the state approvals. Some carriers, are just rolling out still state by state, the extension, the restoration. If you guys have used that product buddy, the group product buddy, where you can kind of select the state, it will tell you where it has that carrier has extension or restoration. They're trying to get all of those options on their products, right? But Robert, because I know you help companies file that, it's not as easy as it seems to get the approvals. You really have to um, approach it on a state strategy basis to see who will get it approved.
It is. It can be tough sometimes. And regulators have a tough job, by the way. Like I don't envy them. They can't be experts in every line of business, and yet they're asked to kind of review every line of business. So we try to give them as much kind of grace as possible. But it can be tough to get these filed and approved in certain states. California and Florida come to mind. Um,
Mhm. And what do you think about the trust filings? You know how some of the group carriers are using like a group trust to get their products approved in 40 states with one filing. What are your thoughts on that?
Man, this meeting got hostile. I'm just kidding. I'm just kidding. I'm just kidding. Um, it's I have a partner who's one of my compliance specialists. I would say it's not like our recommended course of action that a company take. There's a lot of states that are gonna take issue if you kind of file with a trust in another state and kind of get a lot of new business sold through that trust. It does seem to work for many companies. So I guess I'm pretty agnostic to it. Mark is my general response, but it is working for many companies, and um, I think as more and more states kind of catch on to that, that's what's happening. I suspect it'll happen a little less in the future, but I don't know.
Okay.
It's a viable business strategy for a couple of insurers.
I think it's like a beacon of light from a broker perspective,
Oh
where we don't
yeah.
have to wait 6 years to get California all of a sudden. We have it in 90 days. That's like unheard of.
I know I fully understand why people want to do it. And I am someone who wants to get this product into the hands of people. So
Mhm.
I'm into it. From that perspective, I can see some states sort of feeling like they're being circumvented, and you
Mhm.
know, yeah, who knows how they'll react in the end.
Sure.
Um, I wanted to talk actuary for just a minute to kind of give people an understanding of what we're thinking about as we price these products, and this kind of my perspective on these changes when I'm thinking about individual products and group products. But we look at long-term care. Morbidity is our gruesome word for it, where how often people have a long-term care claim and then how long those claims are. If people die or recover, if a claim is more acute, if a long-term care event is more acute, or if it's longer lasting. And then where the claims happen, are they happening in the home care setting or in an assisted living, memory care, nursing home? And then how much of their benefits they use. With some of the worksite products, some of these things are moot. For instance, if the benefit pays out, a flat percent of the face amount every month, and that's the benefit, then it almost doesn't matter like what the maximum amount of your benefit payout is, right? It's just a flat amount. It's like an indemnity type policy. But like if you look at, one of the big individual hybrid policies, they're paying reimbursement for fees, and that's where this kind of assumption about the utilization of maximum benefits matters. The really important assumption um, in pricing long-term care policies on a hybrid basis in the work site is this persistency, how long people retain their policies. Um, for that individual purchaser, maybe they're buying an indexed UL product and they're setting down a large deposit on the first day, and they're saying, I'm planning for my retirement, and this IUL, this protection IUL or accumulation IUL is part of it, and it's got a long-term care feature. They're never going to lapse that policy. Maybe they will, but very few people are going to kind of take their money out of that policy until they start having those long-term care claims. Um, on the worksite side, though, you're paying six, 800, $1,000 for your hybrid life long-term care policy. It could be that when you terminate your employment, that in fact you, instead of getting it deducted from payroll, now it's being, bill is being sent to you. You might decide, hey, $100 a month is a little too much for me. $80 a month is more than I'm willing to spend right now, and I'm just 48, and why do I need this? And so we do see a lot of churn or a lot of people dropping their coverage when they leave their employment, and when they leave the group. So it's a fairly big concern for us. I mean, ideally we wouldn't see that kind of churn, right? I mean, most people want the business to continue. Um, but that's a reality right now in the worksite sale.
Well, and then the positive side, right? Lap supported products do create the ability to get lower price points for the people that keep it.
That's right.
So I
Yeah,
think that also shows why some of the products are competitive even against the fully underwritten individual market.
you're exactly right. When somebody pays their premium for 4 or 5 years in their 40s and then lapses, they've essentially gone to subsidize everybody who keeps their policy for the next 20 or 30 years. So that's exactly right.
I think there's also the factor that most of the marketplace is voluntary at the moment, and meaning the employee is paying the premium, the employer is not funding it. Now, if you had to kind of just ballpark it, Robert, what would you say is kind of a break even for participation rate? Because it's hard to get voluntary participation in long-term care. It just requires a lot of time, a lot of education. What are the carriers you think are looking at to get a spread of risk and a profitable block participation wise? Any thoughts on that?
I think I've heard a couple numbers. I think some people are like, we need at least 25, final sales, or we need 15% is a common,
Hmm.
common ask. So I'd say I've heard those numbers tossed around. Aspirationally, people are looking at 20%, but I don't know too many groups that they get 20%.
Yeah, I would say
Um,
the ones that do actually are the ones that have employer funding. Even
sure,
if you
of
take
course.
out the people that are paid for it, the
Yeah,
voluntary participation increases so much
yeah,
that
absolutely.
you get the persistency. The other thing that I like about the employer funding from a carrier perspective is that more people actually do lapse. Because if you do a base plan for everyone and they're paid for, and then they're leaving the employer and they have the option to take it with them, but they were never really paying for it themselves initially, more people are going to drop those policies. So I think it actually creates a really good environment from the carrier risk perspective. Any thoughts on like how the carriers view employer funding versus voluntary?
I don't have that much thought actually. I haven't done kind of analyses on big employer funded work site cases or group cases for hybrid products. I don't know how, is that very common?
I will say that the vast majority today is voluntary because large groups can get very good offers without employer funding, and it's easier
Right,
to
right.
sell. Hey, you don't have to pay anything for this, and you can bring this new benefit in,
Yeah,
right? That's a slam
yeah,
dunk sale.
yeah.
But if you go to that extra effort to sell the employer funding, you get much better outcomes. And I think that's for everyone involved, quite frankly. The
I
carrier,
think
like we just talked about, the employer is getting value, especially if you can make it an inexpensive starter plan. The price per employee or for a carve out is not that significant relative to other costs like major medical insurance. So to me, that is the secret sauce to this marketplace. I think some of the carriers are catching on from what we hear because they're supporting it a lot in terms of the enrollment, the billing, some of the operational aspects of it. But there's still some carriers that don't really support it. I think from a compliance perspective, they're worried about ERISA or how is this going to be perceived? If it's partially funded and partially voluntary. But we're still trying to push the carriers to do that because I think that's where we're going to see a lot of growth, and especially in the small group market, where
Mhm.
actually we have fewer options there because
Yeah,
voluntary participation is a pretty low percentage. But with employer funding, you're getting the 25, Robert, you're talking about automatically.
yep, yep, that's right.
So I hope to see more small group options and employer funding, I think is going to lead the way there for sure.
I guess I'm trying to think through, is well, not everybody's going to play in the small group market, but for those who generally
Mhm.
are their products even conducive to creating like an employer type offering, like an employer paid offering, or are their
Mhm.
products mostly aimed at a voluntary offering? Does that make sense?
Yeah, they're aimed at voluntary. I think the big missing thing that would make them more conducive to employer funding is tax deductibility for the employer,
Sure. Okay.
right? That is kind of like not even really been fully discussed or explored yet. Is if we can deduct the LTC portion of the premium, why not create a separately identifiable premium group product? So when the employer pays for it, they get a tax deduction and the employee gets tax-free benefits, right? We know how that works in the individual market pretty well. But the group market has not really considered that to be a major selling point yet, nor is employer funding yet prevalent enough. But picture you have a small group, closely held business that wants to do the maximum guaranteed issue for all their key people. They want to also be able to take a tax deduction if one's available to them. But right now they'd have to treat that like an executive bonus deduction, which can be done and, certainly has merit, but isn't as good as an LTC deduction would be.
I see. Um, See, I'm learning something in the study group. What was your billable rate that you charged to your um, the the well, so this is really helpful for me because I speak with these carriers all the time about, what's the next product we can develop in order to grab the next chunk of, and this can now kind of make my list. And Mark, maybe I can kind of follow up with you after, and we can put together what I'd be interested in the group's idea of what a good employer funded plan looks like for a small group, you know?
Sure.
Mm, yeah.
Yeah, the other thing about that, it's a little bit more technical, is I do think group term life also has some tax advantaged treatment. So these term permanent products have
Yeah.
some built-in advantages that have, again, not really been fully explored yet. But you might actually take the tax deduction on the funding of the group term policy above the 50,000 limit. There's some tax advantages potentially. And even the
Okay.
LTC you don't have to think about too much because of that.
Yeah, the LTC piece I'm less concerned about, right? Those seem pretty clearly to kind of
Yeah.
tax favored. Yeah.
And then I do think there is also going to be some group traditional products re-entering the marketplace. Probably the latter half of this year, we'll start to see uh, some carrier take advantage of the gap in the marketplace where there is no true group traditional, but that already has the tax status. You don't have to worry about how it's
Right.
designed. It's
Right.
deductible for all the premium.
Yeah. Yeah. Um, just a couple other things I wanted to touch on. The other things that actuaries love to look at is mortality, how frequently people die. We think it's generally improving. I mean, pandemic aside, mortality's been improving and kind of going down, which is good for people. Strictly from a financial long-term care perspective, that means as long as we can plan for it, that means we should plan for more people being alive for longer. So we try to bake in some expectation that, mortality rates for people who are 80 and 90 today are probably going to improve a little bit in the next 20 or 30 years. The other big thing for any kind of long-term care policy is that long-term care is pre-funding future care and it's spreading risk. And so a big part of that equation is, can a company take a portion of premiums and set aside in reserves and invest those reserves in order to help them grow? And like we mentioned, somebody who lapses after a few years, well, their premiums have gone into the reserve build up, and they're going to contribute. They're going to continue to contribute here. The fact that interest rates are higher today is very bad for mortgages and house buying, but it's probably a little better for long-term care and offering fruitful long-term care contracts at good prices. If interest rates were rock bottom, like in the year 2018 or something like that, the price of long-term care insurance kind of goes up, but as interest rates get higher, the price goes down.
Yeah, that's a really good point. That's what I've heard too, that predictions on the rebound of the long-term care market, if interest rates go up, a lot more carriers are willing to jump in
Yeah,
because it has such a strong effect on their returns and their upside potential too.
it does. That's right. It's also going to slightly soften, future rate increases on in-force long-term care insurance. It, it's not going to alleviate it altogether. It's not going to alleviate the sort of pain that's happening with rate increases. But if an insurance company is, maybe losing a little bit on their long-term care block, but also their investment returns are great, that carrier might be less likely to ask for another rate increase as opposed to a situation where their investment returns are terrible. If they can justify that rate increase in that situation, they might. But if their investment returns are great, then they might say, well, we can put it off for a little while, or we might not need to do that. So
I
it
think the rate
impacts.
stability regulations also probably protect
That's right. That's
the
right.
consumer.
Um, So the usual trends, or I don't know if these are usual, but the trends we see today that are affecting how we price products are, the sort of health and wellness benefits that companies are offering, is that actually going to lead to healthier policyholders and they can kind of price better claims accordingly? It's still kind of up in the air, but I'll say it's high on the list. There are people on this call who are heads of companies that are working towards, improving the health and well-being of long-term care policyholders. Um, we continue to. I expect to see more worksite offerings, and because of that interest rate rise, I expect for annuity policies with long-term care benefits to grow in popularity. And we see new standalone LTC offerings even right now, right? Care Scout has filed a long-term care standalone policy in many states, and Continental General has filed a new one in Texas, and we've got some new standalone long-term care policies on the way.
Yeah, actually, Robert, too, a couple of things on this that I think are really important macro trends. The building in and bundling of services that kind of transcend just the insurance payout, but provide concierge services and help for the family. We're starting to see those on the group products, like family caregiver benefit. Oh, there you go. You thought you froze a little bit. Like a family caregiver benefit, we saw Trustmark announce a partnership with another service in the last month or so. So, and I hear about other group carriers that are trying to include those. I think that could be a big deal because, again, you're selling not just the value of the product, but the fact that we're going to actually help you beyond the product. What are your kind of in the market? What are you hearing about some of those other services that are being included on long-term care policies?
It's certainly it's the current buzz, and it's being offered as a differentiator. Companies are looking to position themselves as, not just this financial transaction, but also we can provide some services for you. And honestly, the hope is like for a mutually positive situation with their customers. That customers actually end up, using some of these care management services, that use some of these kind of health and wellness services while they have their policy, and that ideally that, let's be honest, it's probably not going to prevent fully some kind of long-term care claim. I don't know that I think that right now. Um, but if it encourages, some more health and wellness in the years leading up to a long-term care claim, and you end up, not needing to go into an assisted living facility until you're 80 instead of 79 or 78, that's a pretty big deal from a long-term care insurance company's perspective. A big deal from my perspective too. So I think that's what they're aiming for, Mark.
Yeah.
Product differentiation, but for a benefit that hopefully is meaningful for both parties.
And Wendy and I do webinars quite a lot. And one of the topics we talk about is long-term care planning and healthy aging. But they want to know about long-term care planning, but with a wellness benefit built in, we could talk a lot more about healthy aging too.
Yeah.
So
Yeah,
it really
exactly.
plays well. The other thing I wanted to ask you about is the annuity side. I know we think about that in the individual market right now, and there's definitely a lot of ADL doublers and LTC riders now on products. What about like the 401k market though, the worksite market, where now there's maybe more ability to put annuity long-term care products, that can help to take a 401k fund and create like a long-term care protection plan on the 401k assets. Have you heard about any movement there or challenges there? Because that seems like another big opportunity.
I haven't heard much at all, and I'd say let's do it. I mean, you know, I'm into it. I think it would be awesome. The struggle is, that's it's a pretty competitive market for wallet share, right? Everybody wants your 401k dollars. I feel like my 401ks get bought and sold all the time. So,
Mhm.
um, well, I think
Well,
it's a
they
great
have
idea.
great accumulation, like investment options, but they don't have decumulation, like guaranteed income for life and
Mhm.
long-term care benefits to take your $1 million
Yeah,
that you've saved and turn it into guarantees.
yeah. They should.
Yeah, I think that the Secure Act allowed for that, but I don't know what the product development landscape looks like because it's probably combining two worlds that don't talk to each other very much. Annuity carriers and 401k and long-term care don't overlap in conversation that much.
If you could pick three companies that you would want to have that offer, Who would those companies be? And if it's not cool to say company names, and that's fine, I can just talk to you later. But I'm just
Well,
looking for an
we can
idea.
say it generically. Any company that has a long-term care extension rider is a top carrier in kind of our world, and the people on this call I think would agree with that. So just take any carrier that has an extension rider, and we would that would be a huge differentiator for them.
To be able to offer this annuity with that extension, or sometimes they call it continuation of benefits, right? COB
Correct.
in the
Correct.
annuity
Yep.
world. So, maybe one of those companies out of Indianapolis were to offer kind of a 401k kind of offering or something. Is that what you're saying?
Yeah, one of those Indianapolis companies. That would be a good one to start.
Okay. Okay.
They need a group product first, though. I hope they have one.
Noted. Um, yeah, hesitant to give a presentation without talking about AI, but I do think that it's going to make a pretty big difference to how people actually receive long-term care in the future and the sorts of care that they need. So um, we'll start to see more medical advancements and pharmaceutical advancements, and therapeutic advancements, which is going to help us age longer, but it's probably going to create a more demand for long-term care out in the later years.
Yeah,
Uh,
that's a good point. Actually, we'll probably do, if you want to come back for another session, we'd love to have you back on. We could do a whole session on AI and how it's transforming not only the point of sale decision-making process, but for carriers, on their operations, for providers, on, services. We could think of a lot of different ways that AI is going to really help lower the cost of doing business, which is going to make the adoption a lot greater.
I think so. I think that's right. This is what I had dreamed up to present to you all, and hopefully that's kind of helpful for you. I'll send out, Mark, as soon as those stats are up on my website. I'll send that out if you want to kind of distribute those to the group, or you all please friend me on LinkedIn or connect with me on LinkedIn. It's pretty easy to find me, Robert Eaton Milliman. So would very much like to connect with you all.
Thanks, Robert. I appreciate you being on. And yeah, for anybody that's at the ILTCi, definitely try to get some time if you have a chance. Say hello to Robert, and he's got the pulse of what's going on. I'm sure there's a lot he can't share because he's hired by a lot of the carriers to develop their new products. And they don't want that to kind of get out to the market until they've released it. But you certainly can get a good idea of where things are headed. Bob had a quick question. Please confirm carriers may only invest premiums in fixed income, or may they also assume more risk in, we'll call it S&P fund or like the stock market? What are your thoughts there?
I Is this in kind of like a 401k type investment setting, or do we mean in a general
I think it
insurance?
means in the reserves and just how the carriers are able to use the money to grow
Uh,
their.
yeah, most carriers have a relatively conservative portfolio to grow their reserves, and they don't demand massive investment returns on their reserve. They really need, these days 3 or 4%. Like it's not nothing, but it's also not, 7, 8, 9, 10% S&P, type reserve. So or returns. So that they often do invest in, if you look at like a large insurance company's uh, general account, it'll be, 60 or 70% bonds as an example, some of those treasury bonds with almost no chance of default, knock on wood. And then, there'll be some other instruments, maybe some mortgage-backed securities or something like that, the slightly higher return, slightly higher risk. But the reason that they don't just throw everything into the market is because and try to earn S&P type returns is that's pretty risky in the case of like markets crashing. They want those kind of fixed income investments. And the way that the insurance commissioners kind of enforce that is if people invest in assets that are too risky, there's a punishing formula that says, well, then you have to hold more capital aside because you're investing in things that are too risky. So the commissioners have set up a risk-based capital is what they call it. Companies can't do that without punishing themselves by holding too much capital.
Yeah. And the good news is that if it's priced at 3 or 4%, especially on things that are more interest sensitive, like universal life products. It's a more conservative expectation that the rates aren't going to increase, based on interest rates dropping on some of the products. Some of the products are fully guaranteed as well. Although I could see a market where some private equity gets involved and does some offshore reinsurance, and you could really be even more competitive, but that would create other risks, that I think we'd be more concerned about on a protection product. So I'm kind of glad they're staying conservative on their investments, personally.
Yeah, yeah, yeah.
All right. Well, I know we're going to wrap up here. Really appreciate you, Robert. And just a quick note from the buddy side. Like I said, we're going to be at ILTCi, or I'll be at ILTCi. Definitely touch base with me. The Twilight Wish, which is a charity that I'm on the board of directors for, will have a booth right by the front entrance. Great cause. Really providing wishes to deserving low-income seniors and veterans. So definitely check that out. The conference is going to match charitable contributions dollar for dollar with anything you guys donate there. And also check out the buddy system. We've launched a lot of new tools in the group market, including the group product buddy, which we have on our website as well, and also a group quick quote. So you can actually take 10 different products and compare them to each other on the price and the benefits now inside the buddy system. And Robert, that might be something fun for you to play with too.
That I look forward to it. That would be great.
Yeah. All right, appreciate everyone. Thanks for the time, and we'll see you all next week.
Yeah, thanks everyone.
Bye for now.